manager. In the studio with me in Cape Town tonight is Adam Ebrahim, who's the CEO of Oasis. Adam, let me read the first part of your media advisory, as you call it here. Oasis Global Management Company, Ireland, in brackets, Limited, as part of a global expansion of the Oasis brand, concluded its registration process for 5 of its sub-funds in Switzerland. What does that mean?
Well, it means that our funds are now available in Switzerland for retail and institutional investors to buy and invest in. So like you could invest in our funds in South Africa, our global funds, because we registered in South Africa. So local Irish people can invest freely in a regulated, with all the regulation that Switzerland has, all the regulation that Ireland has. So it's fantastic. It really opens the Swiss market to Oasis.
So they couldn't do it if you hadn't have done this. They couldn't have come into South Africa and accessed your funds, or there would obviously have been a currency factor. What's the advantage?
This is not our South African funds. These are global funds. We have 9 global funds in Ireland. They global funds based in Ireland in our sister company,
yes.
Oasis Global Management Company Ireland, which has been in operation since 2002, and it has its own management, own board of directors, and the regulatory framework that we operate in Ireland is under the UCITS, the European Union regulatory framework. And so we started, in fact, before Ireland we were in Guernsey for 2 years,
yes.
And we outsourced our back office to Royal Bank of Canada. And then we, at the end of 2002, we moved to Dublin with our own offices.
Why did you do that? Why did you go to Ireland? What were the advantages for you?
I think we wanted an English-speaking country, 2 hours east or west of Cape Town. And if you think about it, leads to the UK and Ireland was part of the EU with EU regulatory frameworks, and you don't have any of the risk of Brexit or anything like that with Ireland. So over time, you're able to distribute all your products through Europe. And Europe, South Africa and Ireland and the Middle East are our core markets that we focused in. So we started with the Irish funds. We then took the Irish funds and brought them into South Africa under regulation, Section 65 of the regulation, so we can distribute it in South Africa. Then we took it to Singapore and registered in Singapore. Then in 2012, got it registered in the UK,
right,
and built a full infrastructure in the UK. And you know, if you've been to London, you've been to Harrods. There's a Harrods on the one corner, a Zara on the other corner, and we're the 3rd floor above the Zara. So it's a perfect location.
And what's the other one? Harvey Nichols, just around the corner from that as well.
Yes, so you know, lunch at the pizzeria at Harrods is a fantastic place to do, but a perfect place for wealth management business.
Yes.
And now Switzerland, most probably the capital of global wealth management, being based there gives you access to not only the local Swiss market, which is enormous, but it gives you access to the global market, which is an important market for us.
You say in terms of its competitive ranking, Switzerland holds the #1 position for the availability and affordability of financial services, making it a particularly attractive financial market. Affordability, how important was that?
I think it's important that you produce a high-quality value proposition, and that value proposition is made up of a number of factors: your gross return, your net return, which is after your costs, and then how effective and efficient your administration is, how good your people are, and how accessible it is.
Yes.
Now, what we're doing is we're on a journey to making it very accessible in highly regulated markets. Give you an example. We're now on 7 of the top 10 wealth management distribution houses in the UK.
Right.
We're on the 3rd largest global wealth management house globally. And interesting, that particular organization has 116 asset managers supplying them. And Oasis was ranked #1 out of 116 on service and quality.
Gosh.
Now, this is all part of building a global brand that is recognized for quality service, sound track record in regulated environments where we really focus on looking after people's money and growing it in a low-risk way. And, you know, we've done this for, 18 years in South Africa and 15 years globally. And we think that, you know, with the global village, with the internet and global regulation, we as South Africans need to think with the global perspective. And especially with the rand at 12.75, it's so competitive.
Yes, indeed. The thing that interests me now is what you've been saying. You were ranked number 1 out of 116 in terms of service and other things. How important is corporate governance and adhering to regulations in a responsible way when it comes to attracting funds? I mean, performance is one thing, but the other things you've said obviously are right up there as well.
I think they're very important because your high-quality organizations want sustainable, ethical service providers, and which reduces the risk to them and their clients from a regulatory point of view. And if you provide great service, it encourages efficiency.
Yes.
If you have high-quality regulation, it reduces the risk of litigation or mismatch risk between what clients expect and what you deliver. So there's great transparency, and that's really the market at Oasis. So we're focusing on the global wealth management. So we're not focused on the large corporate pension funds globally.
Yeah.
We focus on the large global wealth management countries, and Switzerland and the UK and Singapore ranks right up there. Think about it, Switzerland, UK, Singapore are some of the most competitive countries in the world that are highly regulated and highly protected, and it's in that environment that we really thrive.
How much increase in fund flow are you going to see? Let's take a normal year. There's no, the markets do their normal thing, maybe up 7-8% this year for the S&P if we're lucky. So no major events that are going to cause too many wobbles. What will this development mean for fund inflows, do you think? For every $100 that you attracted last year, how much increase will there be, do you think?
I think with what we've put in the UK, what we've put in Switzerland, what we've put in Singapore, and what we've put in the Middle East, we've increased our distribution capacity significantly through this. Before the 2012 arena, we had built infrastructure, built the architecture, and all of that's in place now. And many of the organizations will be in our 2nd or 3rd or 4th year. And as you get into the 3rd and 4th year, suddenly the numbers just increase. So we've put on a lot of distribution partners in 2014, early 2015. We should anticipate 2016, 17, 18, maybe a 5 to 10-fold increase in annual flows.
Wow.
And, you know, some of the organizations that we're dealing with are the largest global organizations. So through one relationship, you can deal with them in London, you can deal with them in Geneva, you can deal with them in Dubai, and you can deal with them in Singapore. So all the hard work of putting the infrastructure, the due diligence is done once. And if you get registered and you can service them, and you've got consistency of service, you can you can market more and more into their distribution, and you become a great service provider. And importantly, our funds are also rated 5-star by both Lipper and Morningstar.
Right.
And we have, they're busy doing qualitative reports on us. That's quantitative reports, the qualitative. Now, some of the very largest organizations would only deal with organizations with 5-star ratings. Remember before Standard & Poor's used to do fund ratings?
Yes.
We had the gold rating on Standard & Poor's, and we had the gold rating for more than 5 years consecutively. Now, as you get that, there's just a bigger and bigger pool of high-quality companies
that are allowed to invest in you because of those
Yes.
ratings. Let's talk about the funds now if we can, because this is all very well. You've gone around the world and you've had to go through layers and layers of bureaucracy and lobbying and everything. Oasis Crescent Global Equity Fund, Oasis Crescent Global Property Fund, the Low Equity Balance Fund, the Global Medium, etc. How are they doing at the moment? You mentioned the word conservative.
Yes. So, give you an example. Firstly, those funds were rated 5-star by both Lipper and Morningstar. Importantly, the downside correlation and consistency of returns we rate very, very highly. And so that's an important ingredient. If you look at the globe at the moment, we think the global economy runs at about 3.3% growth, with the US and UK growing very rapidly, Europe coming out of slumber because of massive monetary stimulus. But Brazil, South Africa, Russia, and Turkey are in trouble, currency weakness. In fact, Brazil and Russia have gone into they've actually gone into recession,
yes.
And all these other countries, including South Africa, potentially stagflation, low growth, high inflation, and then China's on the verge of wobbling. So what we've built a portfolio over the last 18 years and 15 years globally is to choose market leaders that have great profitability, ROEs, return on investment. So I'll give you an example, if I can just have a look.
Please do.
If I look at our global equity fund has an ROE of 20.3. MSCI has an ROE of 11.5. So 76% more profits. Okay? And
so have you done this? Give us your philosophy. Who manages the funds and what have you chosen? Is it the same old story of saying, well, we're going to take Nestlé because Nestlé makes a lot of Kit Kats and also sells those Kit Kats everywhere in the world and pays a few dividends here and there?
No, we're going to buy great companies that are going to be the next Nestlé. So, for example, we own an Austrian packaging company, which is a market leader, and in a difficult industry, but just think of it, they've grown and expanded through the cycle, and weak euro, lower energy prices means the input process becomes very competitive, and by the way, demand in Europe is starting to pick up, so that a company like that will have very, very good profitability, very low PE, strong cash flows. You know, we own Pallinghurst, we chatted about it. Pallinghurst has done that, while the mining industry has done that, and yet
well, it did that to start with, though, didn't it? But you're talking about recent times.
Yes, but that's when we're buying into it. So they started off, we bought into the company when it was very cheap, putting in its platforms. We liked what they did, great management. Today they're pulling out rubies out of Mozambique 1 meter deep. Not 500 meters
so
or
this is surface mining.
Surface mining, it's just scratching around. And you know what? They basically spent $2.5 million buying a ruby deposit in Mozambique, and the present value, based on a 15% real discount rate, is over $1 billion. Now, that's a type, and they've done it with emeralds in Zambia. They're doing it in Sri Lanka. So those are the type of companies. So what we're looking for, if I just go back to the average portfolio, we're getting 60% more free cash flow. But importantly, we're buying it at about between 30 and 40% cheaper. But I'm going to give you a statistic. Our debt to profitability is 10% of the average company's debt.
Okay.
So if the interest rate cycle moves up, our companies don't have debt, they've got strong balance sheets.
So you've got a macro feel as well about things. I mean, not just a stock picker, but you've also saying to yourself, well, perhaps if the interest rate cycle does eventually start to rise in the United States of America, then you're cushioned, or your companies are cushioned.
Yes, you always have to take that. You know, we stock pickers, 90% of our focus picking. And you know, our global equity fund produced a return net of costs of 8% versus peer group of 1% over 15 years. And the downside correlation is only 0.68. You know, so if the market goes down 1, we go down 0.68. You know, and so the real alpha that's generated from our portfolios are very, very significant. Other sectors that we like the global...
We're just going to have to leave it there, but we didn't do enough on the funds and your philosophy. Well, you must come back quite soon, but I think the message is it's a landmark moment in Oasis's development. And thanks very much for coming in, Adam. That's Adam Ebrahim, who is the CEO of Oasis.